The insane rise in the price of gold is starting to have a major impact on projects that are coming down the pipe. Projects that are deemed to be small in size are now starting to see massive net present values assigned to them. Because, well, despite the rise in the price of gold, the cost to extract that gold hasn't risen much at all over the last year. With the global economy going down the drain, that might be about to change. But for right now, developers appear to be in a bit of a sweet spot. A prime example of that is Westhaven Gold, who on Thursday filed the technical report for an updated PEA conducted on their Shovelnose Gold project in BC. All right, everybody, let's dive in. Westhaven Gold has updated the PEA for their Shovelnose project in British Columbia, while other operators in the industry have elected to simply revisit prior assessments to reflect the recent rise in the price of gold. Westhaven went about it a bit differently. The company instead elected to both revisit the prior estimate and update it to reflect the change in costing and metals pricing, and to add to the mine plan so as to include recent exploration work conducted on the property. The result is that whereas the old PEA envisioned mining just the south zone of the property, the reworked version adds 2 satellite deposits into the mix. The impact here is that the mine has seen a couple years of life added to it, while also cutting down a bit on the payback period as a result of mine sequencing. When combined with the improved metals pricing, the impact is strongly improved economics for a project that has fairly low upfront costs. Before we get into it, we should note here that Westhaven has elected to report the figures in Canadian dollars rather than US, so keep that in mind when processing the data. Before we get into the hot and fresh version, let's take a quick look at the old preliminary economic assessment conducted here to establish a bit of a baseline. Westhaven first published a PEA on the Shovelnose project in BC back in July 2023, which followed an initial resource estimate that was published in the year prior. Found within the Spence's Bridge Gold Belt in BC, the project is 30 kilometers to the south of Merritt, found just off a major highway. Given the fact that the initial resource was established just the year before, the 2023 PEA was concentrated specifically on the South Zone, where the company envisioned a low-cost, high-margin operation as a result of wide, steeply dipping mineralized vein domains with high-grade mineralization. The original estimate called for a 1,000-ton-a-day underground operation with a 9.5-year mine life, which would boast average annual production of about 56,000 ounces of gold and 284,000 ounces of silver, which was to peak at about 68,000 ounces of gold around year 7. Over the life of mine, 534,000 ounces of gold and 2.7 million ounces of silver were expected to be recovered. With average grades of about 5.37 grams per ton gold and 28.62 grams per ton silver, the geology basically allowed for a low-cost operation despite the small size of the project. Cash costs were estimated at just $804 an ounce, while all-in sustaining costs were pegged at $989 an ounce. As a reminder, that's in Canadian dollars. In US dollars, it translated to about $611 and $752 an ounce, respectively, which is insanely cheap. Initial capital costs were estimated at just $150 million, while life of mine capital costs were estimated as being $247 million. All told, this translated to the Shovelnose project having a net present value of $222 million on an after-tax basis, alongside an internal rate of return of 32.3% and a payback period of 2.6 years. Which was based on a 6% discount rate, $1,800 gold, and $22 silver. At the time, Westhaven notably pointed out that the model, while positive, also allowed for the ability to expand processing to accommodate satellite discoveries, which is basically what they did under the recently updated PEA. Fast forward a little under 2 years, and the company has released an updated assessment, which follows exploration that focused on multiple satellite deposits across the Shovelnose property. Whereas the 2023 study focused entirely on the economics of the South Zone, this latest edition includes the Franz and FMN zones into the mix. The revised version, however, is still, well, a revision, rather than an outright new study. The new assessment has outlined an underground operation that would run for an estimated 11.1 years, producing on average 56,000 ounces of gold and 312,000 ounces of silver a year, with production again peaking in year 7. The revised model, meanwhile, expects to produce 637,000 ounces of gold and 3.6 million ounces of silver over the life of mine. Average grades are largely unchanged despite the addition of two new zones, with gold grades estimated at about 5.3 grams per ton and silver grades estimated at about 32 grams per ton. These grades again have allowed for a low-cost operation to be modeled, with cash costs estimated at $872 an ounce and an all-in sustaining cost estimate of about $11.61 an ounce. Again, that's in Canadian dollars, which translates to 628 US dollars and 836 US dollars an ounce, respectively, which is still very much a low-cost operation by today's standards. Initial capital costs have risen a bit, estimated now at $184 million, while life of mine capital costs have risen a bit dramatically, which are now estimated at $379 million versus the prior $247 million estimate. Keep in mind, however, that this revised model includes two new portals that would need to be constructed, one at each of FMN and France. Those additional ounces have seemingly had a big impact on the economics of the project, with the after-tax net present value rising to $454 million today, alongside an IRR of 43.2%, while the payback period has fallen to just 2.1 years. The figure is based on a discount rate of 6%, alongside with $2,400 an ounce gold and $28 an ounce silver. Of course, that gold price is now somehow nearly $1,000 below current spot levels. And in a sign of just how much gold has ran in recent weeks, when the PEA was released in early March, Westhaven indicated that at current spot prices, $2,900 an ounce gold and $30 an ounce silver, the after-tax net present value rises to $634 million. All right, so let's wrap it up. Westhaven's PEA, assuming production goes to plan, is a great example of why you don't need a Tier 1 asset to make a lot of money mining in this gold environment. At current spot prices, the economics suggest that the company would make about $2,000 to $2,300 an ounce in margin on every ounce of gold they produce, give or take a bit because AISC will rise a bit as a result of royalty payouts. And given that the juniors haven't seen their valuation rise much in the wake of the run in gold, it seems we've entered the calm before the storm. The storm being the wave of M&A and valuation resets that we are about to see. All right, everybody, thanks for watching. If you enjoyed this video, please smash that like button, subscribe, ring that notification bell. Guys, if there's stories you want me to cover, let us know in the comments section. Thanks for watching, everyone.